wasted no time in beginning the transition towards the new liquid endowment approach. A liquid endowment approach is one that focuses on long-term fundamental investments, identifies truly differentiated return sources that we believe are capable of delivering inflation-beating returns whilst supporting a sustainable dividend. With equities at its heart, our approach does not entail allocating to truly illiquid strategies like venture capital or private equity, which require multi-year lockups and where pricing is sometimes subjective or opaque. The Marylebone Partners approach entails three core elements. The first of these we call special investments. These are highly idiosyncratic investments that we've sourced through an ideas network built up over 2 decades. Might take the form of co-investments, special purpose vehicles, thematic opportunities, and a special investment must conform to 3 criteria. The first is it must come through a trusted source, somebody that we know. Second, we must believe that we can monetize the opportunity within a 24 to 36 month time horizon. And third, we must see potential for superior returns. In practice, that means IRRs of 20% or more. The second core aspect of our approach is an allocation to world-class external managers. These are specialist investors, often operating in a niche area, a particular industry, region, or with a pronounced style bias. We have a strong preference for boutique firms and managers who operate in areas of perennial opportunity. The third part of our approach is direct investments. Here we have built a sub-portfolio of direct investments in public equities handpicked by our internal team for their cash flow and earnings potential with a valuation discipline. There's no pronounced style bias to this element, although there is a quality overlay to everything we do, and we focus on large and mega cap liquid stocks, predominantly in the developed markets. One of our distinguishing features, arguably the single distinguishing feature of what we do, is our ability to access investments and opportunities that simply don't come onto the radar screen of other investors. Certainly, we're not aware that they feature anywhere else in the listed investment trust sector. And we believe that capability is going to be absolutely critical over the months and years ahead, because we are not confident that a conventional approach and exposure to generic asset classes is going to deliver inflation-beating returns. The world and the markets have changed, and we feel it's going to be critical to identify the best bottom-up opportunities. Within days of being appointed, we had exited one of the legacy sub-portfolios, and that enabled us to build up immediately our exposure to direct investments. So the 12 or so positions that we've established so far are very varied in terms of profile. There are some value investments, some growthier investments. All of them we feel have really attractive potential in terms of earnings and where valuations are reasonable. This is a terrific time to be putting money to work as an active equities manager. We were also able to secure capacity in certain special investments. Now, this area will take a bit longer to build up, but already we have been able to invest in 2 activist equity co-investments. We've been able to make an allocation to a truly uncorrelated eclectic opportunity in US tax credits, and we've been able to make 2 investments in the specialist credit area, in total return situations in stressed credit that simply didn't exist 12 months ago. At the end of February, we also initiated investments in 12 or so external managers. Again, very varied by profile. They include a mid-cap biotech specialist, a software specialist, a turnaround specialist, a value activist investor based on the west coast of the States, a China specialist manager operating out of Beijing. And we're really excited about the growing opportunity that exists in corporate credit markets. After all the stresses of last year, there have been material dislocations in the corporate credit markets, and that's made it possible for us to deliver total returns in the low teens or better from low-risk investments where the managers we know can deliver good outcomes through a combination of carry and pull to par. So we have allocated to a handful of credit managers, including one based in the States, and one who operates primarily in emerging markets, and one who operates closer to home here in Europe. These are uncertain times, and uncertainty creates opportunity for responsible, fundamental, long-term investors who can identify differentiated return sources. Our team's working really hard to find those opportunities and to combine them in such a way that should deliver good outcomes, but also mean that Majedie Investments will act as a source of diversification. It will be complementary to the other investments our shareholders may hold elsewhere. So as you can see, we've moved swiftly but sensitively to build up the new portfolio. It really feels today like our portfolio. There's enormous breadth of opportunity at present. We're really excited about what lies ahead. We will give shareholders a flavour of some of the individual investments through a series of short videos, which we will post on the website over the months ahead. We plan to report on progress regularly. You should expect a month-end fact sheet to be posted on the website where we'll give good transparency into what we're doing with your capital. From March, we will also produce a performance estimate shortly after the midpoint each month, along with a final NAV for the preceding month. And then we'll produce another estimate of performance shortly after each month end. We look forward to updating you on further progress. In the meantime, we're really excited to have assumed investment management responsibility for Majedie Investments.